Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Continuing with Q3 Outlook series, this week we discuss the outlook for credit markets. Just as a reminder, we've covered macro, equity, and rates outlook in our recent podcasts. This week, to help us understand the dynamics of the credit as an asset class, we once again joined by Prerana, Seth, fixed income strategist at ADCB Asset Management. Prerana, thank you for returning on this podcast.
It's great to be back here again, Kishore.
With the recent underperformance in the USD credit, do you believe it is time to add exposure now?
Aggressive developed market central bank policy stance and increased bond market volatility, they've been significant headwinds for the developed market corporate credit. Bloomberg US investment grade bond index has declined by around 14% in the first half of 2022. A similar drop has been seen in the Bloomberg US high yield bond index too. While these headwinds are unlikely to recede in the near term, we do not anticipate a repeat of the sell-off that we observed in the first half of this year, and that is particularly in case of US investment grade. In fact, the sell-off looks a bit excessive, with US investment grade index having declined to levels last seen during the COVID-19 sell-off. Valuations are also now looking cheap, with the current yield to worst on the US investment grade index trading near the highest level since 2009. However, amidst the rising recession risk, quality still remains key. So we remain neutral on US investment grade, but intermediate US investment grade is looking attractive in terms of valuations versus long-dated US investment grade. In terms of ratings, AA rated bonds look attractive, having underperformed the BBB rated segment recently. In terms of high yield, we maintain our underweight given its strong correlation with the equity markets. In addition to that, signs of rising liquidity risk in US high yield are emerging, with declines seen in new issuances, and that in fact posing risk for the refinancing needs of lower quality corporates. The underperformance of CCC bonds versus BB bonds is already underway in a reversal to the trend seen in the first quarter of 2022.
Let us now turn to emerging markets. Emerging market debt faced significant headwinds in recent months. Do you see the prospects for emerging market bonds improving anytime soon?
So emerging market dollar bonds were the worst performers in the first half of 2022, with the emerging market dollar sovereign recording losses exceeding around 20%. The sell-off definitely has raised the attractiveness of the emerging market dollar sovereign bonds. However, we believe that it is still early to increase allocation. The dollar sovereign bonds in emerging markets are still vulnerable to the further tightening of US financial conditions, which means more funding stress for emerging market sovereigns, particularly the emerging market high yield sovereigns. Broad dollar strength is also a threat for the EMs, given most of these EMs hold dollar denominated debt, making them highly susceptible to increased external volatility. One only positive factor is in favor of emerging market bonds is the signs of turnaround in China credit impulse and the pickup seen in economic activity in China. However, given the rise in external risk at a time when emerging market debt levels have reached record high, we still maintain our neutral stance on emerging market dollar sovereign debt. Based on our credit score model, we continue to prefer emerging market commodity exporters on the back of their strong fundamentals. In addition to our selective preference for a high quality GCC and Brazil, we now also add Oman to the list, which is trading attractive due to its improved economic outlook.
Our regular listeners may know that across assets we prefer Asian exposure. What's your outlook on emerging market Asia credit in specific?
So in emerging market corporates, we still retain our preference for Asia credit, and this is through our overweight stance on Asia investment grade bonds. Asia investment grade bonds have outperformed US investment grade and European investment grade bonds in the first half of this year. Asia investment grade is hence trading slightly expensive compared to US investment grade, but still trading cheap versus European investment grade bonds. China's credit impulse is showing signs of improvement and inching closer to the positive growth rate on a year-on-year basis. And also, latest economic activity indicator in China points to improving growth outlook compared to a weakening growth outlook in the US and elsewhere. And hence, we believe that Asia credit still remains attractive versus the US and Europe investment grade bonds. In Asia high yield, though they are trading at attractive levels, bonds in Asia high yield still continue to remain vulnerable on account of the ongoing defaults of key Chinese real estate companies.
Prerana, thank you very much for joining us on this program and for sharing some of your thoughts on the credit markets.
Thank you, Kishore.
Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast or to access our latest quarterly investment view report, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for the final episode in this series where we discuss Q3 and H2 outlook for currencies. This is Kishore Muktinutalapati signing off.